What if I told you that on one ordinary October morning, the world woke up wealthy and went to bed terrified? By the autumn of 1929, Wall Street stood at the peak of its power, confidence, and illusion. The Roaring Twenties had transformed America into a nation intoxicated by growth. Stock prices climbed relentlessly, fortunes appeared overnight, and the New York Stock Exchange buzzed with optimism that seemed unbreakable. Ordinary citizens, clerks, teachers, factory workers were buying stocks for the first time, convinced that prosperity was permanent. Newspapers praised the new era economy. Politicians celebrated endless growth, and leading economists assured the public that major downturns were a thing of the past. Wall Street had become a symbol not just of wealth, but of certainty. Yet beneath the surface, the foundations were dangerously unstable. The rise toward disaster began years earlier. After World War I, the United States emerged as the world's dominant economic power. Industrial production surged, consumer goods flooded the market, and technological innovation reshaped daily life. Automobiles, radios, and household appliances fueled demand, while easy credit made them accessible to millions. The stock market mirrored this optimism. Between 1924 and 1929, the Dow Jones Industrial Average quadrupled in value. Investors borrowed heavily through margin trading, often putting down as little as 10% of a stock's price and borrowing the rest. As long as prices rose, profits multiplied. Banks, brokers, and investment trusts encouraged this behavior, expanding credit with little restraint. Speculation became the engine of Wall Street. Stock prices detached from company fundamentals as investors bought shares not for dividends or long-term value, but simply to sell them to someone else at a higher price. Rumors moved markets. Tips spread through barbershops and dinner tables. The New York Stock Exchange trading floor overflowed with activity, noise, and urgency. Ticker tapes were way behind the actual prices, forcing crowds to gather outside brokerage offices, straining to read delayed updates. The system grew faster than its ability to control itself. Warning signs appeared, but few wanted to listen. In early 1929, industrial production began to slow. Corporate profits flattened. Agricultural prices had already been depressed for years, hurting rural America. The Federal Reserve raised interest rates to curb speculation, but the measures came too late. Confidence remained high. Then, in October, cracks became fractures. On October 24, 1929, Black Thursday, panic arrived. From the opening bell, selling orders flooded the exchange. Prices fell sharply, triggering margin calls. Investors who could not meet them were forced to liquidate, accelerating the collapse. By midday, chaos ruled the trading floor. Nearly 13 million shares changed hands in unprecedented volume at the time. Leading bankers rushed to Wall Street in an attempt to restore confidence. A consortium led by Richard Whitney, acting on behalf of major banks, publicly purchased large blocks of blue-chip stocks, echoing past rescue efforts. For a moment, the market steadied. Newspapers reported cautious optimism. Many believed the worst had passed, but the relief was temporary. The psychological damage was done. Trust had cracked, and fear spread faster than facts. The following week sealed Wall Street's fate. On October 28th, Black Monday, and October 29th, Black Tuesday, selling intensified beyond control. On Black Tuesday alone, over 16 million shares were traded as prices collapsed across the board. Billions of dollars in market value evaporated within hours. Fortunes vanished. Investment trusts collapsed. Banks that had invested depositors' money in the market faced insolvency. The roaring optimism of the 1920s gave way to disbelief, then despair. Wall Street, once the symbol of unstoppable prosperity, became the epicenter of financial catastrophe. The true conflict of the crash of 1929 did not end when the market closed, it had only begun. The collapse shattered confidence not only in Wall Street, but in the entire economic system. Banks failed by the thousands as depositors rushed to withdraw savings. Businesses closed, unemployment surged, and global trade contracted. What began as a market crash quickly evolved into the Great Depression, the deepest and longest economic downturn in modern history. By 1933, nearly 25% of Americans were unemployed. Industrial output had fallen by almost half, and millions faced poverty and hunger. Wall Street's collapse had rippled outward, reaching every factory, farm, and household. At the center of the storm stood the New York Stock Exchange, scrutinized as never before. Critics accused Wall Street of reckless speculation, market manipulation, and moral failure. Congressional investigations exposed abuses in insider trading, misleading financial statements, and conflicts of interest between banks and brokers. The crash revealed how deeply unregulated markets could destabilize society. Faith in financial elites collapsed alongside stock prices. The once glorious trading floor became a symbol of excess and irresponsibility. Yet from this devastation emerged reform. The comeback was slow, painful, and transformative. Under President Franklin D. Roosevelt, the federal government fundamentally reshaped Wall Street. The Securities Act of 1933 required companies to disclose truthful financial information. The Securities Exchange Act of 1934 created the Securities and Exchange Commission to oversee markets and protect investors. Banking reform separated commercial and investment banking through the Glass-Steagall Act, reducing conflicts of interest. These changes marked a turning point. Wall Street would no longer operate unchecked. Transparency, accountability, and oversight became the new foundation. The New York Stock Exchange itself adapted. Trading rules were tightened, margin requirements increased, and safeguards introduced to prevent panic-driven collapses. Over time, confidence slowly returned. The market recovered unevenly, but lessons endured. Wall Street emerged, humbled, regulated, and permanently changed. It was no longer just a playground for speculation. It was recognized as a powerful institution whose stability mattered to the entire world. The payoff of Black Thursday lies not in the destruction it caused, but in what it revealed. The crash exposed the dangers of unchecked optimism, excessive leverage, and blind faith in endless growth. It proved that markets are not infallible, and that prosperity without discipline is fragile. Yet it also demonstrated resilience, the capacity of institutions to learn, reform, and rebuild. Wall Street survived its darkest hour and emerged transformed, carrying scars that shaped every crisis and recovery that followed. Black Thursday remains a defining moment in financial history, not merely as a warning, but as a lesson. It reminds us that at the heart of global money and power lies a fragile balance between confidence and caution. When that balance breaks, the consequences reach far beyond the trading floor, and when it is restored, it reshapes the future. The crash of 1929 did not end Wall Street, but it forever changed what Wall Street would become.